Ladies and gentlemen, good day and welcome to Q2 and H1 FY23 earnings conference call of Nuvoco Vistas Corporation Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Desa from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and thank you for joining us on Nuvoco Vistas Corporation Limited's Q2 and H1 FY23 earnings conference call. We have with us Ms. Madhumita Basu, Chief of Strategy and Marketing. Before we begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may be viewed in conjunction with the risks the company faces. The company does not undertake to update them. A statement in this regard is available for reference in the presentation shared with you earlier. We will begin the call with opening remarks from Ms. Basu, who will share perspectives of the business model and strategy and the outlook of the company. For this, we will have the forum open for an interactive Q&A session. I'd now like to hand over to Ms. Basu.
Thank you, Gavin. Good afternoon, everyone, and a warm welcome to the Q2 FY23 earnings call of Nuvoco Vistas. To start off with the cement demand, East has witnessed a healthy double-digit demand growth during the quarter on YOY basis, driven by housing and rural segments, coupled with lower base effect of last year. North region also saw modest demand growth during Q2, backed mainly by housing segment, followed by infra. Strong momentum in urban housing despite increase in interest rates and property prices, improvement in post-festive season rural demand, and expectation of retail inflation cooling augur well for near-term demand. Despite the cut in projections by various agencies, India maintains its position as the fastest growing major economy in the world. Government's continued thrust on capex, improvement in capacity utilization in manufacturing, and pick up in non-food credit should sustain the expansion in industrial activity and give the necessary fillip to the cement demand growth in the country. Cement demand will also continue to witness major support from government's consistent thrust on programs like Pradhan Mantri Awas Yojana, Pradhan Mantri Gramin Sadak Yojana, and boosting spends towards major infrastructure development projects. This gives us enough confidence about the India growth story. Returning to Q2, this being a seasonally weak period, we saw continuous softening of prices starting end May. However, with demand picking up in May, we were able to take some price recovery in the months of September and October. Further price hikes remain essential to mitigate the impact of soaring costs. With modest demand growth in North, the region didn't witness any hikes and prices remained muted during the quarter. If we look at the regional price movement on YOY basis, Nuvoco has delivered realizations better than the market prices by activating internal levers with continuous focus on premiumization, trade shares, and geo-mix optimization. Moving on to costs, the most talked around topic. Cost pressures continued to impact the cement industry during the quarter, majorly led by elevated fuel prices and inflationary pressure on key raw materials like slag and gypsum. While we saw some cool-off in the petcoke prices for a brief period, the softness was short-lived. In the meanwhile, we utilized alternative fuels and waste heat recovery systems more efficiently, along with effective fuel procurement and consumption strategies. As a result, we achieved one of the most efficient power and fuel consumption rates in the industry during the quarter, standing at INR 1,554 per ton of cement. A quick update now on our key ongoing capex programs. We are working on clinker capacity enhancement projects in Vistas and Nimbol through debottlenecking, and expanding our Bhiwani unit in Haryana to a 1.2 million tons per annum grinding unit, which will take our overall cement capacity to 25 million tons per annum. We are progressing well on our sustainability agenda-linked projects of alternative fuels material handling at Vistas and Nimbol plants. we recently inaugurated and commissioned the co-processing system at Vistas, which enabled us to initiate the feeding of alternative fuels. Work on full facility with pre-processing system is underway. Civil work at Nimol for similar facility is ongoing. This will give us the thrust to improve our AFR, which is a key positive in today's high fuel cost environment. I would now like to share the progress on key sustainability initiatives. We are focusing on enhancing the use of alternative fuels, improving the share of composite cement in our mix, and conserving natural resources. Happy to say that we are progressing on all these parameters and sharing here a few highlights. As mentioned during previous calls, we have one of the lowest net carbon footprint in cement industry at INR 478 kg CO2 per ton of cementitious material in FY22, duly validated by CII. Sorry, I would like to correct. Footprint in cement industry at 478 kg CO2 per ton of cement in FY22. My apologies. Our AFR has improved by about 5% on YOY basis to touch 9% in Q2 FY23. With the ongoing investments in the material handling system, we are targeting to achieve an exit rate of 12% by end of this fiscal. We are also one of the largest producers of blended cement. We continue to deliver best in class with our clinker to cement ratio standing at 1.8x during the quarter. Within 1 year of launch, we are on track on our composite cement sales. With premium offerings in mind, we recently launched Duraguard Extra foundation to finish cement in Bihar market, which is a premium composite cement. Our 6 ready-mix concrete plants have been recently certified as Green Flow Eco-Level plants. Here we will be manufacturing our EcoDure product line. EcoDure is a revolutionary range of low carbon concrete or green concrete that can reduce the carbon emissions up to 60%. Briefly touching upon our ready-mix and MDM businesses. Both the businesses are performing well. We have 52 operational ready-mix plants across the country. Our value-added products mix improved to 30% during the quarter under review. Company remains committed to product innovation and has launched Concreto Glide, a premium quality, effective solution designed for interior and exterior flooring underlay. In modern building materials, we have extended our customer reach with expansion into non-cement channels and tapping new markets. Moving on to our financial performance for the quarter, our consolidated cement volumes improved by 15% YOY to 4.4 million tons in Q2 FY23. Our revenue from operations improved by 19% YOY to rupees 2,401 crore, driven by higher volume and price increases in both East and North. Quickly commenting on the 3 cement cost elements. Raw material cost per ton increased by 24% YOY amidst the inflationary pressure on key raw materials like slag and gypsum, coupled with a higher consumption of slag in line with our thrust to improve the share of blended cement. Power and fuel cost was effectively contained at rupees 1,554 per ton. We will continue to focus on optimizing fuel mix, improving AFR, and internal levers like higher utilization of waste heat recovery systems, as they have been yielding results for us. Distribution costs during the quarter increased by 8% YOY with higher freight costs. Our consolidated EBITDA for the quarter stood at rupees 194 crores. We continue to focus on our internal levers, which is helping us to navigate through these tough times. Broadly touching upon a couple of highlights, our share of premium products improved by 4% on YOY basis to 38% of total trade volume. Trade mix stood at 72%. Project Sprint, which is to get synergies with the integration of new Vistas operations, has been continuously on track. I take a moment now to share with great pleasure and pride in this investor forum that Nuvoco has won the Golden Peacock Award for Excellence in Corporate Governance. This is a testament to our commitment to implement best-in-class governance and management systems. The solicitation ceremony is being held today. Lastly, I want to spend a few minutes to explain our medium-term plan for the company and where we are heading. It's been more than a year now since we are listed, and there has been a lot of things happening in the industry since then. While we have been continuously interacting with you, I would like to take a pause moment here and reiterate our plans. Balance sheet strengthening remains our key priority, with our efforts focused upon bringing down net debt to our comfort level. In FY25, we will be a 25 million ton player. This provides sufficient capacity headroom to sustain near double-digit volume growth on FY22 sales volume base, reinforcing our position as the fifth largest cement group in India on current state basis. To support our growth, we will continue to invest responsibly for the long term in a way that is responsive to the current economic environment. Our next phase of growth is planned in North and West India. Progressive updates on our expansion projects shall be provided quarter upon quarter, considering and calibrating the industry dynamics and company performance. In the meanwhile, we will keep our focus upon improving our sales volume through better capacity utilization, paring our debt, dialing up our internal levers, and relentlessly driving cost optimization programs. With this, I will end my opening remarks. I am joined by Mr. Jayakumar Krishnaswamy, Managing Director, and Mr. Manish Agarwal, Chief Financial Officer. We are here together to take your questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may enter star and one on your touchtone telephone. The first question is from the line of Abhimanyu Kasliwal from Choice India Limited. Please go ahead.
Good day to the management. Am I audible?
Yes.
Okay, perfect. Hello. So I wanted to ask specifically, I believe Ms. Madhumita Basu right now mentioned that we are hoping to reach a capacity of 25 million tons by FY25. As the current capacity I understand is roughly in the vicinity of 20 to 22, does that mean that we are not looking at great capacity expansion over the next 2 to 3 years? That was my first question. The second question was, if we are looking at greater capacity expansion, then are we looking at organic or inorganic growth? And thirdly, I wanted to know margin expansion. What is the situation? I mean, fuel costs, they seem to be elevated, but is that the only thing we are depending on to see some kind of margin expansion, or do we have other value addition projects, or we are depending on price recovery to take place strongly in October, November? These are my 3 questions.
We are going to the
Could I?
First question was how do you increase capacity to 25?
But I couldn't, we can't hear you. Can you please repeat?
Sorry to interrupt you. I'll just reconnect the line. Please.
Yes, please.
is the operator. We have the line for management reconnected. Please go ahead.
Abhimanyu, thank you for your question. The first one, I will repeat the perspective. I mentioned that in FY25, we will be a 25 million ton cement player. The max is our current capacity of 23.8 million tons and a 1.2 million ton grinding unit, which is coming up in Diwali. And I further reiterated, we shall be providing progressive quarter-upon-quarter outlook on further expansion plans.
Fair enough. So regarding the question of organic, inorganic expansion doesn't really arise because it seems that we are not really looking at capacity expansion over the next 2 years. Am I correct in my understanding, ma'am?
So inorganic opportunity is something we do not have for evaluation on our table right now. The 25 million ton stated capacity is basis organic growth.
Fair enough. Lastly, then, since our capacity is going to remain stable, are we looking at some kind of margin expansion or besides price recovery? Are we doing some value addition in our products, hoping to earn a higher margin, or we will remain in the same band that we have been in the past year or two?
Abhimanyu, we are looking at our guidance for sales for this year, FY22 base is something like 20 million ton of cement. So at a 25 million ton capacity, we have adequate headroom to take double-digit growth for the next 2 years up to FY25. So there is going to be value increase in the business. Added to this, of course, we will be dialing up, as we have been mentioning, our premiumization, our geo-optimization, and trade shares.
Fair enough.
I want to reiterate that there is good volume headroom in this 25 million tons.
Again, I'm just not clear. What is, according to the company, what is the current capacity of the company right now?
This is 23.8 million tons.
Okay, so from 23.8 to 25. Okay. Thank you very much.
Thank you.
Thank you. Participants, to ask a question, you may enter star and 1 on your touchtone telephone. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Good evening, everyone. Couple of questions. One on the capacity expansion. The company won the favorable verdict for limestone in North. As you evaluate different options, if you had to look at downfield expansion, maybe the capital cost for that project in North, and when could we possibly look at the timeline for committing one way or another, whether west or north, to expansion in the equipment, in the corresponding equipment ordering for that project? Is that something that could happen this financial year? That's my first question.
Yeah, let me just take that, Satyadeep. I guess I've been speaking about the capacity expansion in the last 2 quarterly calls. So we have options to grow for Nuvoco in west via Gulbarga and north via plant in Rajasthan. And as I mentioned in the previous calls, based on the attractiveness of the market and the pricing, we would make a call in either of these zones. While we have clear limestone mines and approvals in Gulbarga, the one in Nimbahera and the other 2 mines in Rajasthan, like Nimbahera, I had already mentioned that it was pending with High Court, and I think some development is happening there, and we would be in a better position to comment on that in the coming quarter. As regards what kind of infrastructure facility we will plan to expand, if it were north plan, our idea is to do a brownfield, and if it's going to be a west plan, it will be a greenfield, split grinding in both the cases. And in terms of capacity, if it's going to be brownfield, obviously it's going to be much lower than greenfield site. As regards timing of project as well as the starting of construction equipment ordering. I have to say that there is no such plan as we speak right now. Like I mentioned in the previous quarters, based on the company performance as well as the market dynamics, we will take an appropriate call, and in every one of this earnings call, we will update all of you about the company's future expansion plans. As of now, it is the brownfield expansion in the company which we are up to will take the company from 23.8 to 25, as against a volume of 17.8 million tons last year. We still have headroom for 8 million tons to do in the next 2 to 3 years, which is substantial amount of growth for the company in a period of 24 to 36 months. Lastly, as I mentioned in the previous call and also as Vita mentioned in her speech, the priority for the company is to kind of make the balance sheet healthy, and once the market improves, then we will come back and announce the further mega growth expansion plans.
I just want to talk a little bit on this. The brownfield, if it is, let's say, 6,000 tons per day with a corresponding greenfield split GU, typically the benchmark we would see for such a project would be about $70, give or take that. So it will be substantially lower than $100 per ton greenfield. Would that be correct understanding if we look at a possible brownfield project?
You are right. I think that's the kind of ballpark numbers one will look at. As regards whether it's 6,000 TPD, 7,500, 10,000 TPD, I guess we will make an appropriate call. But as we stand today, these are the numbers which we also have in mind about the brownfield expansion dollars per ton and greenfield expansion dollars per ton.
Okay. Thank you. Secondly, on the power and fuel cost, two-part question, somewhat longer term. There are 140 odd blocks that have come up for auction, coal blocks. Would Nuvoco be interested in bidding for some of these blocks for captive coal? And there's a lot of incentive from the government for open access, group captive and stuff. Is there a possibility if you have to look at more renewable, even from where you are, it's relatively high green energy mix you already have in the portfolio, but incrementally if you have to look at it, is there a possibility that the company may look at setting up more renewable capacity, or you would look to maybe tie up with merchant producers for maybe round the clock solar power in future?
I think 3 points. I think first step is as one of the amongst the industry players, we have WHR all our kilns, and our connected load for WHR is about 45 megawatt, and between WHR and CPP we have about close to 23% of the solar capacity coming in. In addition to that, we also have solar plant in two plants of Nuvoco. What are our steps? As you said, number of coal blocks are coming up for auction. A year and a half ago, when a couple of blocks came up for auction in Chhattisgarh, we bid for it, but then we couldn't kind of succeed in the bidding process. But constantly we are on the lookout for coal blocks in Chhattisgarh, Jharkhand, well, because our plants are located there. So very much we will be participating in any auction that will come up. Number 2 is the thrust area for the company for fuel is setting up alternate for processing facility. We now have 2 plants in North, both Chittor and Nimble will come in January, but both plants will have full-fledged AFR pre-processing as well as co-processing. Risda in East also will have pre and co. Once we have these 3 plants running at pre and co, we are looking at close to with these 3 plants we will get anywhere about 20% of AFR. But then Sonadi and Arasmeta are the other plants where currently we are operating at about 3%, 5%, 6%. But once these 3 plants get commissioned, we will look at setting up AFR facility in Sonadi. The second thrust area for the company will be to scale up the AFR in fiscal FY23-24. The third point is green power. As you mentioned, if there are going to be open access options and we partner with somebody or we tie up with organizations to get 24/7 solar power, we are constantly on the lookout and certainly explore that possibility. On our own, we are exploring solar power for our GUs in Panagarh, Babua and Jajpur, and also the Nimbol facility where we have an option to set up somewhat 5 to 7 megawatt solar power plant. So that's how our process is stacked. First step is to bid for coal block whenever it happens, and we should get it. Second one is to maximize the AFR. And the last one is to look for green power wherever it is available so that we have competitive advantage in the power cost for the company.
Thank you so much. Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. So the first is on the capex for this 1H we have done 173 odd crore. Last time we said 500 to 600 crore for this year. So what's the number? And for FY24, if west and north expansion, if you don't go ahead, then what's the capex? And if we go ahead, broadly, how much would be the capex that we will be spending in 24 and 25?
Yeah. Thanks, Shravan. Last time when we met and in the call as well as the pre-prayer call, we had mentioned that we would outlay for the various expansion projects, non-field and sustaining capex of the companies, close to about 570 crores. Out of which in H1 this year we have done 173. And most of these projects, whether it is the Bhiwani GU or the Nimbol debottlenecking in AFR, Sonadi railway siding, Jajpur railway siding, and Risda debottlenecking as well as AFR. All these projects are on track, and we would in the next 9 to 12 months, all these projects are going to be completed, and this 500 crores will be to set up, complete all these expansions. That's the outlay going forward. As regards the large expansion, whether in west or in north, as I mentioned in the previous question as well as in the previous call, the timing of the decision is going to be based on the deleveraging as well as the market dynamics and the overall performance of the company. And every quarter I would come and mention when do we start the construction activity. Suffice to say that both the places we are in a very good position to start. The day we decide, we can start very quickly.
Okay. And currently, in terms of the date, in the first half has increased 220 odd crore. Last time we mentioned that this year we will be repaying 600 odd crore and 1100 crore in next year, and we will be debt free by FY26. So, any change in stand in this?
So, as I mentioned last time, that next repayment in this year would be 600 crores, out of which we have already repaid 300 crores in H1. And with regard to the next year also, the numbers are at 700 crores. So we are on course to doing the repayment this year. As regards next year's repayment, last sum of repayment, I guess we are on course to do the repayment next year as well. In case the business environment and the industry environment continues to be difficult, hopefully it improves. But as of now, the fuel price doesn't seem to taper down in Q3 and at least in Q3, maybe Q4 it may come down. So we'll have to kind of find a way to rebalance the capex spends to ensure that we meet all the repayment criteria, which I guess we are in good position.
Now on the operational front, in terms of the pricing post September, how much price hike we have seen in our markets?
Like we mentioned, between Q1Q this year and 2Q this year, 2Q obviously prices reduced from 1Q, whereas end of September, middle of September, there has been a marginal increase in prices, which is nothing which is not a very encouraging sign. But come October, some price increase happened. But I'll have to say in October, we've already had a non-trade price increase on the first, as well as trade price increase we did 2-3 days ago in East. So I think welcome sign. Certainly we'll have to find a way to take the prices up to compensate for the cost inflation.
So broadly, how much increase we would have taken from the 1st October till date?
1st October till date, I guess, because this happens in various states and sometimes you take up but then immediately gets corrected. But I can give a ballpark number. It's a modest number. I think starting from October 1st till today we are sitting on November 10th, anywhere you can look at between 10 to 15 rupees in various markets in East. Not much of movement in pricing has happened. All the pricing movement has happened in East.
Okay. I need a couple of data points on the fuel mix for this quarter and consumption cost per kcal basis for linkage, non-linkage, imported coal, petcoke, AFR for this quarter.
I think to give a fuel mix details for every line item, it is an assumption because as we stand today, we can't get because linkage coal is dependent on SCCL availability. Yeah, and every time they release the GO, the assumption changes. Like last time during your earnings call, I mentioned that we got an SCCL allocation of 12 to 13%. But that certainly has improved between early Q1, early Q2 to Q3. So I think that should improve. But as the availability of other coals, petcoke, I can safely say they are operating anywhere between 45 to 50%. North is all petcoke, East trending between 45 to 50%. And the balancing is all the domestic open market coal. And domestic open market coal is a function of how much linkage coal we get.
So for Q2, in terms of the consumption cost per kcal basis, what would be, because last time we shared the number for linkage coal, non-linkage coal, imported coal, petcoke, and AFR. For the FY23, what would be the number? Just wanted a comparison.
If you want to give me a granular detail of fuel mix, I guess that's something which is privy to our data. But suffice to say that the power cost we reported 1554 rupees per ton of cement. But to give because the multiple types of coal coming in, I think in a call like this, I don't think it's appropriate to give every little detail of every part, every fuel which we are using in all the factories. But we are very pleased if you want more details, I guess our investor relations teams will be happy. On a one-on-one call, we can give you details for your modeling. So
broadly in the Q3, how much? Just a continuation also in Q3, broadly how much we expect in terms of the power and fuel cost. So because we take the RM also in that, so you combine put together RM plus power and fuel, how do we see how much decline we can expect in the Q3?
I guess from across the industry as well as we are part of the industry, I think fuel cost is more or less peaked actually. So unless any adverse events happen going forward, whatever is the fuel price which existed in August, September, I guess is existing in October. There has been a marginal reduction about $20 a month and a half ago, but again it shot up, petrol prices went up actually. But suffice to say that the prevailing rates of mid to end Q2 is what is currently prevailing. But for our company, the positive thing is the commissioning of the AFR facilities in Vistas as well as Nimbol, and also setting up the co-processing and pre-processing. Our alternate fuel consumption usage will keep on increasing from Q1 to Q2 to Q3 to Q4. And I can give a guidance on this. By the time we come to January, February, we should anyway trend between 9 to 10% would be through AFR, which will be one of the best in the industry.
Okay, thanks.
Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah, good afternoon, sir. My first question is just confirmation. So, despite a fairly muted capex in first half, you're looking to close the year at 500-600 crore of capex for 23. Is that right?
Your voice was a little bit feeble. Can you repeat the second sentence, please?
So despite fairly muted capex in first half at 173 crores, we are still looking at 500-600 crore capex for FY23. Is that right?
Yeah. Maybe give or take 50 to 100 crores we should be able, because all projects are on steam actually. It's all happening. And as you would see, many of these projects are based on civil fabrication and rest of all the stuff. All the equipment ordering for this fourth brownfield expansion is done. So maybe give or take 3 months here and there, but all projects are happening. The Bhiwani expansion, Nimbol expansion, Vistas expansion, and Jashpur and Sonadih railway steering.
they're on course, so maybe give or take 100 crores. I can't exactly say that I will spend 570 crores or 490 crores, but it will be in the ballpark of about give or take 70, 80 crores based on timing and the progress of project. Nothing beyond that.
And related follow-up, when is the clinker debottlenecking expected to complete and Bhiwani expansion timeline?
The Vistas clinker expansion from 10,500 to 11,000 has already happened. Nimbol 4750 to 5750, as we speak, the civil is done, fabrication is happening. I guess sometime in March or April, based on the season as well as the window where we can take a shutdown, we will do the hookup of the new systems and the current kiln because we need to take a shutdown of 3-4 weeks. So I guess that's the time. We'll have to choose based on the demand in the market and the clinker stock which we have. So it could be give or take 1 or 2 months for the Nimbol clinker to go to 5750. But suffice to say, Q2 next year, we should have 6,000 TPD Chittor and 5750 TPD Nimbol. As regards Bhiwani, public hearing is done. We are just waiting for the EC for us to do the main plant construction. However, the clinker silo and cement silo construction has already happened because that's part of the current plant expansion. And our target is again by August next year, Bhiwani should also be on stream. So safe to say that when we hit Q3 next year, North will be 6 million tons of cement capacity.
Pratik, do you have any further questions?
Yeah, just one more question on synergies. So we had this targeted synergy of 250 over 22 and 23 with 2 more quarters remaining. So where we are in terms of synergies we had targeted for over this period.
So Pratik, firstly I would like to reiterate that all programs are identified under internal levers are under execution and governance cycle check with excluding. Due to the overall elevated cost pressures, this is not immediately visible at an aggregate level. Some of the key levers would be in terms of higher premiumization, opportunities for cross-sourcing, and this, as you will have noted, we've been updating quarter-upon-quarter basis. So largely on track, unless we face some headwinds going forward.
The big projects and internal levers for premiumization, as Mita said, our premium percentage has gone to 38%. The second project was launching double bull in North. That is also ticked off. The third project was getting composite cement. That's also ticked off. The fourth project was cross-sourcing amongst the New Vistas and Nuvoco facilities. There I can say, if I have to give a ballpark number, 80% of the intended cross-sourcing is almost done, but we are currently reworking the optimizer model to do a live optimizer change every week so that we can maximize the last rupee for optimization. In terms of best practices of raw materials and fuel mix and use of slag and use of gypsum, activated gypsum, all of it between Nuvoco and New Vista plants are 100% completed.
Sure. Thank you, sir. These are my questions.
Thank you. Next question is from the line of Tejas Pradhan from Citigroup. Please go ahead.
Yeah, hi. So on your capex plans, would you like to quantify a debt level or debt EBITDA level which you consider would be comfortable for the company to consider starting either north or west expansion?
Yeah, very clear. I guess we like we communicated last call and the prayer call. We would look at the debt level of this company at 3,000 to 3,500 crores, and till such time we hit that number, we won't do a large scale expansion. So it will be the current expansions will take us going for another 24 months from 17.8 million last year to reach to 25 million tons, close to about 7.5 million tons of headroom is there for the company to grow, and 24 to 36 months is good enough time for us to grow 7 million tons over 17 million tons. As regards debt, as I mentioned, till we hit between 3 to 3,500 crores, we won't go for a large scale greenfield expansion either in north or west.
Sure. Thanks. And just one more question on your composite cement. Could you share what is the current share of composite cement in your total sales mix? And if you plan to increase this, what could be the target over here?
Tejas, Concreto is our competitive advantage, and this is a call going on record.
Composite cement.
Composite cement, yeah.
Oh, my bad. I heard that as Concreto cement. Composite cement in our mix currently is about 11%.
And how much do you want to take it up to according to your plans?
Capacity building we will be doing at a 3 million ton kind of level. Some plants we will have to progressively take up the volume. But since you asked for an end state, that would be 3 by roughly 23 million tons, which would be about 11-12%.
So composite cement is the only need. So our goal is to get a CK ratio excess of 2 in each. So for getting the CK ratio excess of 2, I guess composite cement, as Meeta said, should be about 3 million tons should be the target. Overall company can, with an installed capacity of 23.3 on 23 is the number we will go to hit for. But then each piece will be 18. That will be close to about 1.6, which is 16%.
Okay, great. Thanks. And lastly, if I may just squeeze in, lead distance, if you could share, what was it for this quarter?
Just a second. Our lead distance in Q2 is close to about 335 to 335 kilometers.
Sure. Thanks a lot.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good afternoon, and thank you for the opportunity. So just one couple of clarification. One for FY24, after this 500-600 crore capex, what would be the pending or spillover capex for the existing plans, and what is the level of maintenance capex we incur every year?
Typically, our maintenance capex anyway trends about 125 to 145 crores, so that would remain. Plus, also, I guess we have to keep on purchasing land for our limestone in the adjacent areas of our mines. Small plots we have to keep on buying to secure limestone for a longer period. So that is typically between 50 to 60 crores. We're looking at close to about 200 crores of routine capex as well as mandatory capex. Rest will be the carry forward of some, as I said a little while ago, 570 is what we want to do. Maybe it could be anywhere between 490 to 570. If some of these projects get spilled over by 2 to 3 months due to construction activities, maybe some 80-90 crores will come from this year, another 200. So we're looking at about 300 to 350 crores as we speak, if we don't take a very large scale expansion.
Understood. So second question with respect to our preference, north and west, we have two options. What would be our market preference be to start with, number one? And second is the balance sheet comfort is the only factor which is stopping us? So once we achieve this 3,500 crores kind of a level on the net debt, we can start, or are there other market factors which we are keeping a tab on to take a decision?
First of all, let me clarify, there are no market factors. The only factor is, I guess, as an organization, we need to keep growth as well as debt as well as profitability, or the three things as a company we need to manage. So certainly the large scale growth projects will come once the debt level, we are comfortable at 3 to 3,500 crores. So that will be a principal criteria for us to kind of go for the next phase of large scale expansion. As regards market factors, I guess, as I said, I don't think we have any criteria to choose expansion based on market factors. Market factors as in industry performance and coal cost will certainly decide what be one of the key criteria for us to make a expansion announcement.
Understood. So that's very encouraging to hear the rationality on the leverage side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Naveen Sahdev from Nuvama Institutional Equities. Please go ahead.
Yeah. Good evening, sir. Good evening, everyone. Just one question. In your initial comments, you mentioned apart from the Bhiwani grinding unit, the company is also pursuing with clinker debottlenecking. So if you could just help us that post this debottlenecking, the clinker capacity of the company goes up to how much and by when? Thank you.
Just give me a moment to reiterate the specific projects we have talked about. In North, post this debottlenecking, we will be 6,000 in Chittor and 5,750 in Nimbol, roughly 11,750. And in East, our end state would be 27,050 between all the plants. That would take the capacity to up by 8.9 and 3.9.
So East our clinker capacity will be 8.9 million tons post all the debottlenecking. North our clinker capacity will reach to 3.9 after debottlenecking.
Correct. So you said 8.9 in East and 3, how much? 3.9
in North.
Roughly 4 million tons is clinker.
Right. So okay. So total it's about 12, a shade under 12 million ton will be our clinker capacity post expansion.
It will be 13 million tons. 8.9 is 9, 3.9 is 4, 9 plus 4, 13 million tons of clinker for the company.
Correct. So 13 million tons and are usually the maximum, as in if I see your past performance, on an average the clinker to cement conversion ratio that is worked is more like 1.7. So at full blown utilization, the maximum cement what you can produce is about 22 million tons. My question is only from the point that next year in the run up to the elections, there is a possibility of a very strong demand, and I'm just trying to understand how prepared are we in terms of and of course there is room for growth now, but if I were to look at it from a slightly longer period of 2 to 3 years, the maximum we can go up to is 22. Is that a correct understanding?
Our current rated capacity is 23.8 million tons. The C/K is continually increasing. As I mentioned, we are currently running at a 1.8x.
1.8.
Rated installed capacity is 23.8 million tons, and we are adding 1.2 million tons in Bhiwani.
Understood. No, this is helpful. Again, I believe we'll be definitely at 1.8. It can clearly be 23.5 plus kind of a volume. That's what I wanted to understand. Thank you. Thank you so much.
Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please enter star and 1 on your touchtone telephone. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi. So I want to understand what sort of trade share improvement you are targeting in next 1 year?
So our target share is trade share is 75%. We are currently quarter levels trending around 72 to 73%.
Okay. We have discussed about the fuel. What I want, maybe I might be asking the question again. What is the fuel mix for this quarter and what is it costing on Kcal basis?
On Kcal, I can give you a rough figure of about 2.64. You will have to reach out to our office for granular details of the mix.
Okay, understood. Thank you. That's it from my side.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you. Sir, in terms of the RMC particularly, so still we are having a EBIT loss. Though the quarterly run rate this quarter and the last quarter also 230 to 25 crore we are doing a revenue. So when can we start seeing the EBITDA profit, and to what extent we can expect? So will RMC continue be having the EBITDA loss even if this year we will be doing close to 1,000 to 1,100 odd crore RMC revenue, 1,000 crore, then also we will be having a EBITDA loss?
No, RMC certainly we are not at EBITDA loss actually. In Q2, our EBITDA margin is 6% in RMC, and we have clocked an EBITDA of close to about 12 odd crores. At H1 level, our EBITDA margin in RMC is close to 5.6%. In fact, RMC is safely back to pre-COVID levels for us, getting a revenue of 420 crores in H1 and an EBITDA of about 24 crores, translating to 5.6%. So RMC is well on way to pre-COVID numbers. I think by the time we end this fiscal, RMC will be at FY19 levels.
Okay. Secondly, just wanted to understand in terms of because our cost also includes the cost for the RMC. So in terms of the freight cost particularly, so if I whatever the absolute number we have given in the P&L divided by the volume, then it comes to 1,416. So that is a 11.8% QOQ decline. Though our lead distance remains same QOQ. What explains this decline in freight cost?
Shravan, I would request you to refer to our investor presentation for the distribution cost, which has already been adjusted on all these line items. So this is a 1376 INR per ton figure and has increased 8% on a YOY basis. I mentioned in my speech that it is a freight-related cost impact.
So whatever the difference is that let's 1,300 number what you are saying, if I multiply that into the volume, whatever the number comes and actually reported in the P&L, what would be the difference? What explains that difference in the freight cost? Hello. Hello. Hello.
Rajesh Kumar, please confirm if you are able to hear us.
Hello.
Yes, please proceed with your question.
Okay, I was not able to hear the management line. Yeah. Hello, am I audible?
Yes.
Yeah. Hi, sir. Maybe I have missed during your the earlier discussion due to poor network at my end. Two questions just on the per kilo cal on a blended basis. What was the total cost in Q2 versus Q1, and the sequential fall, a decline in the logistics cost per ton? What explains this? This number. Would you please let us know?
Fuel cost Q1 to Q2 was 2.28 rupees per million cal in Q1, and it went up to 2.64. As I mentioned, we kind of peaked on the fuel cost now, and from now on, I guess once the coal prices and petrol prices come down, that's when it will come down. Otherwise, the current trending rate is 2.64. One way Nuvoco will be able to reduce this through increased AFR consumption in the coming and the subsequent quarters. As against distribution cost,
You are referring to the distribution cost decline quarter upon quarter. We had mentioned in the last call, Rajesh, that there was a rake shortage, and we had to mobilize clinker by road from to our GUs. So that is a situation which improved in this quarter just gone by. I think there is some disturbance on the call. I'm not getting a response from you and Rajesh.
Am I audible?
Yeah, now you are.
Okay. So what I'm saying, this Q2 logistics cost is more representative on a normal basis?
Yeah, you're right. Q1 was a little bit of anomalous because there was serious rake shortage because all the Indian Railway rakes were used for supplying coal to the power plant. So during the call, I had mentioned that there was a big impact because we have close to about 50% of rail share. So that one is kind of situation certainly improved in Q2.
where we got adequate rakes. But as we speak, the rake shortage is kind of come back to haunt us from 15th of October. Hopefully, I guess November onwards, we are expecting better rake availability.
Oh, okay. Great, sir. That's all from my end. Thank you.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just a couple of follow-up questions. Just wanted to clarify that the intent strategy is that unless the company achieves 3,500 crore net debt, there would be no announcement for either north or west capacity expansion. Right? That's unless the net debt number is achieved.
Yeah, I guess even in the prior calls we had mentioned that as a company we have to grow, but we will decide our large scale growth plans moment we hit our debt numbers at between 3,000 to 3,500 crores. The primary objective now will be to pay the debt. However, we need to grow, as I said a little earlier, from 17.8 million tons of actual last year. We can still become a 25 million sale company, not capacity company. 25 million of sales can happen in 24 months. And all of us know that to grow about 7 million tons over 17 million tons, it will not happen overnight. It will take 24 to 36 months for it to happen. So we are sufficiently having headroom to grow the company in terms of volume with the current capacity. Large scale expansion of a new facility will take time, and that is interdependent upon the debt of the company coming to 3,000 to 3,500 crores.
Just want to clarify on this that given that debt reduction is a function of market conditions, if market conditions are supportive, it could happen sooner, but if they are not, it could take much longer. The target is that debt reduction is primarily predicated on internal cash flows only. Right? That's banking on internal cash flows to the debt reduction. And what is the clinker and what is the utilization level you're seeing in north? If there is some delay, just trying to figure out where you're operating in north in terms of utilization level.
Yeah, I guess two parts. First one, obviously, the phasing of the announcement of expansion will be subject to overall performance of the industry as well as our company improves based on the cost inflation. I'm only hopeful that the current trend of not being able to pass on the cost inflation is this cannot be a long-term phenomenon. I think time will come when we'll have to compensate for the cost inflation. So I think we will have to correct the system going forward in the next maybe 1 or 2 quarters. As regards the second bit of CK ratio, I think capacity utilization, you will all be aware that our company before the acquisition of Emami always operated at 95% capacity utilization. So I guess one of the key things which we are good at is to run the company at the excess of 90-odd% capacity utilization and still be able to meet the market demands and grow the organization. So east is all going to be exhausting the capacity which we have in the next 18 months. Whereas in north, currently we have a installed capacity of 4.8 million tons, out of which we are able to sell about 3.6, 3.7. But then with Bhiwani coming in and the GU coming in, it will be a big competitive advantage for us to sell in markets of Delhi, Haryana, Punjab and those regions. Hence our ambition is to kind of grow the market in north all the way up to excess of 5.5 million tons, even touch close to 6 million tons.
Okay, thank you so much.
Thank you. That was the last question. I now hand the conference over to management for closing comments.
Thank you. Thank you for your questions. Just to summarize, cement demand is expected to witness a healthy uptick in FY23 with the strong momentum in housing and government-led infrastructure development projects. While we had a modest price increase in the eastern region, high fuel prices will continue to affect near-term profitability. Key watch will remain on fuel costs. In the meanwhile, we will continue to focus on internal levers, operational efficiency, and remain committed to our ongoing expansion plans. My team and I remain available for any clarification required. Do connect with us. Thank you for joining us today.
Thank you. On behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.